Mortgages are most commonly thought of as the loans used to buy a house. But I can tell you that mortgages are also used in the business world to secure property, offices, you name it. A mortgage is a loan with the security of a lien on the borrower's real estate. A lien is a document filed by the lender to record its claim on the property in the case that the borrower is unable to pay the loan back. The borrower is liable for the unpaid principal balance plus any accrued interest expense. Mortgage loans commonly require monthly payments on the principal and interest stretching over a number of years. From a bookkeeping perspective, there are a number of things to keep in mind. A mortgage is on a piece of property or building, and so that asset should be sitting pretty, right there on the books for all to see. We already talked about how assets are recorded on the books, but in addition to the asset, there should also be a corresponding mortgage on the books as well. Another important point is the aspect of time. A mortgage is a long-term loan that will require several years to pay off. One of the biggest takeaways, though, is that any bank loan involves an outside party, which is the lender themselves, who now have a vested stake in the business. There's going to be more scrutiny over the books, and so business owners, like Xavier, need to make sure that their books are in good order. These might sound like trivial things, but their importance can't be overstated. Let's listen to an expert as they share more about mortgages.
As we talk about mortgage loans, we probably are thinking immediately of our own homes, and perhaps we have a mortgage on our home and we have borrowed money to buy a house. Well, businesses can do the same thing. They can borrow money to buy a building or property, and that is a mortgage. A mortgage is secured, meaning that there has been some legal document that has put information on that property stating that if it was sold, it's going to be paid off first, usually. And so there's going to be an asset on the books. That seems pretty obvious, but it's not always happening. So we need to make sure that if we have a mortgage, that there is an asset on the books. The other thing that I often want to make sure is just for good uh, clerical records that the asset is in the name of the business as well, and the mortgage is as well. So all of that resides on the books. And of course, just like at home, you have interest and principal and possibly an escrow. All of those types of things could come into play as well with a commercial mortgage. And so you're going to see that there, again, there's an asset. The loan itself would be listed as a liability. Of course, with a liability, we consider that whether it is a current liability or a long-term liability. Typically, a mortgage is going to be paid back over several years. And since current liabilities are for 1 year, long-term liabilities are for more than 1 year, a mortgage would be considered a long-term liability. Depending on the business, they may decide that some of that mortgage loan repayment that's going to happen over the next year could be moved over to be a current liability. And so those are some changes that could happen sometimes in discussion with an accountant that may want to do those types of things. So just know that that is very common and could happen depending on the types of reporting and financial statements that need to be made. With each payment that happens, there is going to be principal payment and interest payment. Depending on the business, they may need every single payment to be split up that way. Other small businesses will just true it up or reconcile that at the end of the year to record the interest, because that is the expense piece of that payment versus the payments toward principal, which reduces the liability as they repay that loan. And so again, just like at home, those are the same types of things that could happen with a business. And so recording all of that accordingly is important to make sure that all of that is handled properly. The books are up to date, the assets and the liabilities are as they should, and of course the income and expenses are all taken care of as they should as well, to give a real reflection of how that mortgage is affecting the client's entire financial picture.